Did you know that Islamic finance became extremely popular right after the global financial crisis by people of all faiths? This was especially true for those who were directly affected by the crisis, because the whole foundation of Islamic finance is built around such a way that it plays down the severity and frequency of financial crisis. This is because Islamic finance is all about risk sharing. While many of the Western conventional banks defaulted during the crisis, no major Islamic bank was reported to do the same. Islamic finance is not about us versus them, like the way many retail investors feel about the Wall Street. It is about us. Research by PwC found that Sharia compliant investing is growing at about 15 to 20% per year. Doesn't matter which faith you follow or don't follow, stay tuned to learn more about this fascinating area of investing. Hi guys, I hope you're all doing well. Let's start with the basic foundation of Islamic finance, its core values. Islamic finance is based on the belief of sharing both risk and profit between people. And this profit or loss must always come from a tangible wealth of value. Basically, it cannot be purely created out of just money. According to the law, money should not have any value in itself. It is simply a way of exchanging products and services. And so the main features of Islamic finance are no interest. Since you cannot make money out of money, the concept of interest rate is completely forbidden in Islamic finance. This includes interest on deposits that you get paid from your money that you put in the bank, and the interest that banks charge you for taking out a loan with them. This makes Islamic finance extremely unconventional. So unlike in commercial bank, when you deposit a certain money in your bank account, they pay you a certain interest on that amount. When it comes to Islamic bank, the money that you do deposit with them, they invest that money into some of the tangible growth assets, and the profit that they get out of their investment, they share that with you. The second foundation of Islamic finance is no harm. Another important idea that underpins Islamic finance is that your investment and the money must not cause any harm. For that reason, Islamic finance services do not invest in things like alcohol, tobacco, and gambling. And the third concept is around partnership, as I have just mentioned. Islamic finance encourages partnership. This means that where possible, both profit and loss should be shared. This can be between two individuals, an individual and a business, or a business and a business. So when it comes to things like buying a house and taking out a mortgage, unlike commercial bank, Islamic finance, they can do that for you in different ways. One of the ways is that the bank can actually go out and buy that house on your behalf and then sell it back to you at a premium. And when that happens, they tell you upfront exactly how much money you have to pay back to the bank every month. So there is no sense of uncertainty or impact in the change in the amount of money that you have to pay back to the bank based on movements in interest rates. A second way of buying a house would be to jointly buy it with a bank. So just like your equity loan that we take with, say, Help to Buy, it works in a similar concept. The bank will hold certain ownership in your property until you pay back that money to that bank. This brings me nicely to the next concept of having no uncertainty. Any sort of investment that holds a high level of uncertainty or ambiguity is not permissible under Islamic finance. This is the reason why gambling is not allowed. So by this belief system, you can already imagine that certain types of investment will not be prohibited under the Islamic law. Let me help you summarize them, starting with the stock market. So when it comes to stocks and shares, they are okay to invest under the law. And this is because stock investments, they are actually tied to a tangible underlying business. And when it comes to dividends, they're simply profit sharing. So dividend investing actually gets a brownie point according to Islamic finance. However, you have to be mindful that there are certain intricacies around the type of company stock that you can actually invest in. For example, the company you invest in must maintain a debt to equity ratio of less than 33%. This automatically rules out businesses with high level of borrowing. This means that ultimately the type of company you're investing in will be much more stable. Now, when it comes to bonds, by its very nature, it is not acceptable under Islamic finance. However, there are Islamic versions of these bonds or bond-like instruments which are called sukuk. The main difference between sukuk and a normal bond is that when you're buying or investing in a normal bond, you're lending your money to another company and you don't have any ownership to the type of product or the businesses that the company operates in. So you're not sharing the profit or loss with them. You are essentially getting an interest because you're lending them the money. But when it comes to sukuk, you actually share the profit and loss of the underlying product of the company that you're lending the money to. So in terms of bonds, you get a share of return, so a share of profit of that product over a future defined date, as well as your initial money back. Did you know that UK is the first country outside of the Islamic world to issue sovereign sukuk in 2014? And again this year, the UK did a second issuance of this sukuk, totaling £625 million. The profit rate, which is equivalent to the yield number when it comes to bond, was set to 0.33% with maturity of July 2026. It follows a certain structure so that the profit that you are getting back is underpinned by rental income from a number of different government offices and properties across the country. So in that sense, the government is sharing their profit with you because you have lent some money to the government. Next, when it comes to real estate, it gets a big tick next to it. Real estate is a significant part of asset allocation in the Islamic world, and it accounts for some of the largest Sharia compliant funds. And the same concept and reasoning goes with commodity investing. So things like investing in gold, silver, and oil, because they do have a certain tangible value assigned to them, they're perfectly okay to invest. Now, when it comes to derivatives, so things like short selling or using a lot of leverage, they are not allowed according to Islamic law. This is because derivatives fails to tick a lot of boxes we spoke about around uncertainty, interest cost, and partnership. So that big squeeze by hedge funds on GameStop, absolutely a big no according to Islamic finance. Now, when it comes to cryptocurrency, it is a bit of a gray area at the moment. There are no official reasoning to it. Some says yes, some says no. Take Bitcoin, for example. It can be argued to be non-permissible because of high level of uncertainty, ambiguity, and having no underlying tangible asset, economy, or market assigned to it. Plus, it has the potential for abuse by fraudulent activities as well. However, others will argue that it is okay as an investment because it is used for a medium of exchange and the law does not require the currency to have any intrinsic value. So I'll leave the argument around cryptocurrency to your own sound judgment. So guys, I hope you got a really good taster into the world of Islamic finance. If you are someone who wants to follow this more strictly going forward, there are plenty of funds and investment opportunities out there for you to start looking into. Do let me know if you have any follow-up thoughts or questions around this concept in the comment section below. And until next time, look after yourself and your money.